Did you know the U.S. private credit market has quietly grown into a $1.70 trillion industry, and it's beating both stocks and bonds in returns? Here's the shocking part. Most regular investors don't even know what private credit really is, or how they might get a piece of it. If you think traditional investments, like the S&P 500, are the only way to grow wealth in 2025, this video will make you think twice. In the next few minutes, I'll break down what private credit actually means, why it's booming right now in 2025, how it compares to stocks, bonds, and real estate, the risks that could cost you big if you're not careful, and a bonus tip on how some investors are finally getting access without being a millionaire. By the end of this video, you'll know whether private credit belongs in your portfolio or if it's a risk you should avoid. Let's start simple. Private credit is lending money directly to businesses without going through a traditional bank. Think of it as a company needing a loan, but instead of a bank, it's private investors who step in and provide the funds. In return, investors earn interest payments, often much higher than what you'd get from bonds or savings accounts. It's like being the bank without actually owning a bank. Would you ever feel comfortable lending directly to businesses for higher returns? Comment yes or no below. I'll reply to as many as I can. Here's the big driver. Banks are pulling back. Since 2008, regulations have made traditional banks more cautious about lending, especially to mid-sized companies. That left a huge gap, and private lenders filled it. In 2025, with high interest rates still in play, businesses are desperate for flexible loans. Private credit has become the go-to solution. Investors love it because returns can range from 8% to 12% annually, much higher than many traditional bond yields. What's the highest return investment you've personally tried? Drop your number in the comments. Let's compare private credit to traditional investments. Stocks are great for growth but volatile. One bad quarter and prices swing wildly. Bonds are safe and predictable, but current yields don't always beat inflation. Real estate is tangible and lucrative, but it requires big capital and management headaches. Private credit sits in the middle, lower volatility than stocks, higher returns than bonds, and often less hassle than real estate. That's why institutional investors like pension funds and endowments are pouring billions into private credit. And if you're wondering, do regular investors have any way into this space? Stick with me. I'll cover that in the bonus tip. Of course, it's not all sunshine. There are risks you need to know. Your money can be locked up for years. That's called illiquidity. There's default risk. If a borrower can't pay, you could lose money. Access has always been a barrier too, because historically, only accredited investors, millionaires or institutions could participate. And if a recession hits, defaults can spike fast. So while the returns look shiny, you need to understand you're not buying a stock you can sell tomorrow. If you had to choose, would you prefer higher returns with more risk or lower returns with safety? Let me know. Private credit isn't for everyone. It's ideal for high net worth investors seeking diversification, institutions looking for steady yield, and experienced investors who understand risk. But here's the exciting part. New platforms are emerging in 2025 that open the door for smaller investors. Think of it like how Robinhood made stock trading accessible. Similar platforms are now starting to make private credit investments available in smaller chunks. Here's the insider fact most people don't know. Private credit has historically outperformed public bonds even during market downturns. For example, during the COVID crash, many private credit funds still delivered positive returns while stock markets were down double digits. And now, some fintech companies are packaging private credit deals into fractional investments, where you don't need $1 million to start. This could be a game changer for regular investors in the next 2 to 3 years. Imagine earning 10% a year while your friend's savings account is paying 4%. That's the appeal. Now I want to hear from you. Would you actually consider adding private credit to your investment portfolio, or do you think it's too risky? Drop your thoughts in the comments. I'll reply to as many as I can. Thanks so much for watching. If this video helped you understand private credit better, hit that like button. It really supports the channel. And make sure to subscribe, because tomorrow I'll cover 5 alternative investments you can start with under $500. And trust me, you won't want to miss it. See you in the next one.